For a year, I mean literally a full year, Wall Street basically treated UnitedHealth like a broken company.
Oh, completely.
Right. Costs were just spiraling, regulatory crosshairs were locking in, and staggering 45% of its market value was just wiped out, completely gone.
Oh,
Investors were bracing for impact. And then, Tuesday morning happens, Q1 2026 earnings drop.
yeah.
And instead of crashing, the stock rockets up, nearly 8%?
Yeah, adding tens of billions of dollars in market cap in just a matter of hours. It was a violent repricing.
Right.
Because the prevailing narrative going into this print was absolute panic. You had this blue chip, industry-defining behemoth that everyone just assumed was fundamentally impaired.
Yeah, exactly. So let's unpack this, because a surge of that magnitude demands serious scrutiny, and we're not just going to read the headlines here.
No, we never do.
Right. We're doing a deep dive today. We've pulled from a massive stack of financial transcripts, press releases, and market analysis regarding UnitedHealth's Q1 print to figure out what actually happened under the hood. Because if you look at the top line, the numbers look fine.
Yeah, just fine.
Revenue hit $111.7 billion, which is up 2% year over year. Adjusted EPS came in at $7.23, beating the $6.76 estimate. But let's be real. Delivering the slight beat on top-line revenue does not add tens of billions in market cap.
No, it doesn't. And here's the primary insight that everyone needs to grasp right out of the gate. The market didn't reward management for making more money.
Yeah.
It rewarded them for keeping more of it. If you are analyzing a health insurer, revenue is honestly a secondary metric.
Right, because of the payouts.
Exactly. The entire game is dictated by how much of those collected premiums are flying right back out the door to pay for hospital visits, surgeries, prescriptions. That brings us to the medical cost ratio, or MCR.
The magic metric.
The magic metric. Last year, it sat at 84.8%. This quarter, it dropped to 83.9%.
Okay, we need to contextualize that 0.9% drop for you guys listening. Because in a business doing, $111 billion a quarter.
It's massive.
Yeah, keeping an extra fraction of a percent is the difference between an earnings miss and an absolute windfall. But why did an 83.9% MCR trigger such a violent stock rally?
You have to look at how institutional investors were positioned, right? Going into the print, analysts had braced for an MCR well over 85%.
Oh, wow. Okay.
Yeah. The working assumption across Wall Street was that healthcare inflation and these post-pandemic utilization rates were just spiraling out of management's control. Delivering an 83.9 proved that the cost spiral had actually been arrested. It signaled that the executive team has its hands firmly back on the steering wheel.
Okay, I'm going to push back on that narrative, though.
So for.
Because when you dig into the accounting behind that 83.9%, it doesn't look like a sudden masterclass in operational efficiency.
Well,
there are some massive tailwinds here that have absolutely nothing to do with fixing the structural issues of healthcare inflation.
yeah, that is a completely fair point. We absolutely have to separate the core business improvements from the one-time benefits. This quarter was heavily aided by two distinct factors outside of pure cost management. First, a demonstrably milder respiratory and flu season.
Right, which naturally depresses hospital and clinic utilization.
Exactly. But second, and honestly much more important from a financial engineering standpoint,
Here we go.
they recognized a massive benefit from net prior period development, or PYD reserve.
Wait, let's stop there. Prior period development.
Yeah.
So you're telling me a massive chunk of this, this incredible earnings beat wasn't them fixing the underlying business. It was just them finding money in the couch cushions from old accounting reserves.
The mechanism is a bit more complex, but yeah, the result is basically exactly that. Because of the lag between when a patient visits a doctor and when the insurance company actually processes the final bill, insurers hold billions of dollars in what they call incurred but not reported reserves.
Okay.
So they actuary out an estimate of what they think they owe for the previous quarters. And this quarter, UnitedHealth realized that those old outstanding claims were going to cost roughly $500 million less than they originally feared.
So it's essentially like a casino holding back millions in the vault to cover potential payouts from high-rolling whales, right? And then once the whales leave the floor without hitting the jackpot, the casino gets to release those funds back onto the balance sheet as pure profit.
That is a perfect analogy, yes. When a $500 million reserve release hits the income statement, it artificially depresses the medical cost ratio for the current quarter. So the key takeaway for anyone analyzing this stock is that UnitedHealth has not entirely solved healthcare inflation.
Right. The math is still tough.
The actual underlying medical cost trends, what it costs to treat a senior for a hip replacement, those are still elevated. The 83.9% represents massive relief, but it is not a normalized run rate. The market cheered, but the structural work is far from over.
Right, which brings us to the actual structural fix.
Yeah.
Because if management knows that an accounting tailwind and a mild flu season aren't going to save them next quarter, what are they doing? And the strategy they're deploying right now seems completely counterintuitive to me.
You're talking about the membership cuts.
Yes. In almost any recurring revenue business in the world, growth is the ultimate metric. You want more subscribers, you want more users.
Yeah.
But UnitedHealth is currently executing a deliberate, massive contraction. They are projecting a loss of up to 2.8 million members in 2026.
Yeah, this is a textbook execution of a shrink-to-grow strategy.
Shrink to grow.
Exactly, and it is a necessary pivot. For over a decade, the managed care industry was engaged in this aggressive land grab. The prevailing theory was that accumulating as many covered lives as possible would naturally generate scale.
And scale translates to profitability.
Right. But the macro environment has shifted. Volume for the sake of volume is now toxic to the bottom line.
Let's break down exactly who they are cutting loose, because 2.8 million paying members is a massive exodus. It's wild. This breaks down into three main buckets looking at the sources. They are slashing roughly a third of their Affordable Care Act individual exchange business.
Yep.
They are contracting by 565,000 to 715,000 members in Medicaid, and they're losing between 1.3 million and 1.4 million members in Medicare Advantage. How does stepping away from that much revenue translate to a stronger business? I mean, really.
We have to analyze the unit economics of each of those populations. You can't just look at top-line revenue. Start with the Affordable Care Act exchanges. For a decade, that specific market has barely contributed to UnitedHealth's earnings.
Oh, really? Barely anything.
Barely anything. The consumer base is highly price-sensitive, churn is super elevated, and the regulatory oversight is incredibly heavy. So by stepping back from a third of that business, management is simply excising dead weight.
Okay, that makes sense. But then you look at the Medicaid contraction. That isn't just natural churn. They are actively shedding high-acuity, complex patients.
Right, and the math there is driven entirely by the states. State governments determine the funding and reimbursement rates for Medicaid. Right now, those state payments are falling desperately short of the actual clinical reality of treating these patients.
So the reimbursement rates are just totally disjointed from the medical acuity.
Completely, but the most significant and telling strategic retreat is happening in Medicare Advantage.
The 1.4 million members.
Right. Across the industry, medical trend costs in Medicare Advantage are running at roughly 10%.
10%.
10%. That is a scorching rate of inflation, and it's driven by seniors utilizing outpatient care at absolutely unprecedented levels.
So UnitedHealth looks at a 10% cost inflation trend and realizes that, heavily subsidizing zero premium plans and offering crazy supplemental benefits just to win market share is a fool's errand.
It's totally a fool's errand. So management aggressively repriced their Medicare Advantage plans for this year. They pulled back on those supplemental benefits, the gym memberships, the dental allowances. They went into the year knowing full well that they would lose over 1 million members to competitors who were still willing to subsidize unprofitable growth.
The competitors take the losses.
Exactly. The members UnitedHealth retained would actually generate a return on capital.
And it's not just the insurance arm doing this. The clinical delivery side, Optum Health, is executing the exact same playbook. I mean, they are narrowing their affiliated provider networks by nearly 20%. They're dropping unprofitable PPO contracts and just walking away from risk-sharing deals with hospital systems where the math no longer works.
Right, and by shedding this unprofitable volume across both the payer and provider sides, management expects to improve their Medicare Advantage margins by 50 basis points.
Which is huge.
In a managed care industry where operating margins are razor thin, a 50 basis point expansion is a massive fundamental shift. It signals a management team willing to endure the terrible optics of a shrinking membership base just to protect the integrity of the balance sheet.
Okay, so Shedding bad contracts definitely improves the top-line quality. I get that.
Mm.
But what about the actual operational machinery of the company? Because when you look at the Q1 data, their operating cost ratio actually increased to 13.8%.
Right, up from 12.4% last year.
Yeah. If they are shrinking the member base to save money, why is the cost of running the business going up?
Here is where we separate the casual investors from the pros. The increase in the operating cost ratio is driven by a massive, aggressive capital expenditure cycle. UnitedHealth is plowing $1.5 billion into technology and artificial intelligence initiatives this year alone.
Ah, the AI buzzword.
The AI buzzword. But the market treats AI like a magic wand that instantly reduces headcount and prints money, right?
Right. Everyone thinks it's instantaneous.
But the reality is that integrating these systems requires immense upfront capital. It is actively hurting the bottom line today.
It's the equivalent of trying to replace the engines of a commercial airliner while it's still at cruising altitude.
Yes.
While you are buying the robotics, retraining the crew, and tearing out the old infrastructure, your balance sheet looks terrible. It's wildly expensive, highly disruptive. But if you want to structurally lower your altitude of operating costs for the next decade, you have to spend the money now.
And we aren't talking about launching a shiny, generic customer service chatbot here. This is about administrative demolition.
Administrative demolition, I like that.
They are applying machine learning to the most archaic, friction-filled processes in the entire healthcare system. The sources highlight a specific tool within OptumRx called PreCheck. It targets the prior authorization process.
Oh, man. That is the ultimate choke point in healthcare.
The absolute worst.
A doctor prescribes a specialized medication, and then the patient waits in limbo while the payer side and the provider side argue over whether the insurance will actually cover it. Historically, that required, nurses and clinicians faxing documents and sitting on hold for hours.
Literally faxing. The manual review process historically took over 8 hours of administrative bloat per claim.
8 hours.
8 hours. OptumRx deployed this AI tool, and they reduced that approval time from over 8 hours to under 30 seconds.
Wow. From 8 hours to 30 seconds. Think about the financial shockwaves of that efficiency. You are completely eliminating the human friction from the most common transaction in your entire business.
The resulting data is just staggering. They achieved a 68% reduction in denials due to missing clinical information. They saw an 88% reduction in costly, time-consuming appeals.
That's incredible.
Currently, 95% of all their prior authorizations are handled electronically, and 50% are processed in real time without any human intervention at all.
So that is what a $1.5 billion capital expenditure actually buys you?
Exactly. Management is modeling a 2-to-1 return on these tech investments over the next few years, with many specific tools paying back within 12 to 18 months. Investors have to view this spend not as a drag on Q1 earnings, but as the construction of a permanent strategic moat. The 8% stock surge on Tuesday was driven by the relief of the medical cost ratio, sure. But the durability of the stock's multiple over the next decade will be dictated by this structural overhaul of their SG&A expenses.
Okay, so let's talk about that multiple. Let's look at the valuation. We have a heavily engineered MCR beat. We've got a deliberately shrinking membership base designed to rescue margins, and a massive CapEx cycle focused on administrative demolition. How is the broader market valuing this specific concoction right now? Because looking forward, investors need to know what catalysts are actually going to move the needle from here.
The valuation is demanding, to say the least. The stock currently trades at a price-to-earnings ratio around 24.5.
That's steep.
It's a premium multiple. It signals that the market has already aggressively priced in a lot of this operational recovery and margin expansion. The easy money from the post-earnings short squeeze has been made. To justify further multiple expansion from a 24.5 PE, management has to execute flawlessly.
But they are signaling immense confidence in that execution, right? I mean, they're aggressively returning capital to shareholders. They generated a massive $8.9 billion in operating cash flow in just the first quarter.
Which is huge.
That represents 1.4 times their net income. And they weren't just sitting on it. They pulled a $2 billion share buyback forward, accelerating it to Q2. They are paying a dividend yield of 2.72%, and they actually raised their full-year earnings guidance to over $18.25 per share.
The balance sheet is an absolute fortress. There's no denying that. But we have to identify the forward triggers, the macroeconomic or regulatory events that will either validate that 24.5 multiple or fracture it entirely.
Right.
The primary positive catalyst looking ahead is regulatory relief on the federal level.
Specifically regarding the Medicare Advantage rates for next year. Right.
Yes. The federal government finalized a 2.48% Medicare Advantage rate increase for 2027. Now, if you ask UnitedHealth executives, they will loudly complain that a 2.5% bump doesn't come close to covering a 10% medical cost trend.
Of course they will.
But look at the macro impact. That rate increase adds $13 billion of top-line revenue to the sector. And more crucially, it removes a massive overhang of regulatory uncertainty. It gives institutional investors the long-term visibility they demand.
But the regulatory threat hasn't vanished entirely. It's just changed zip codes. While the federal picture is stabilizing, the sources explicitly highlight a massive looming risk at the state level that the broader market seems to be completely ignoring right now.
Yeah, the consensus is deeply underestimating state-level legislative risks, particularly concerning pharmacy benefit managers, or PBMs. The sources point directly to a legislative battle unfolding in Tennessee that threatens the core economics of OptumRx.
Right. And to understand why this matters, you really have to understand the PBM business model. A PBM is essentially the middleman. They sit between the drug manufacturers, the retail pharmacies, and the insurance plans. They make their money by negotiating rebates and utilizing spread pricing.
Right.
Essentially charging the insurance plan one price for drug, paying the pharmacy a lower price, and just keeping the spread. OptumRx generates over $35 billion a quarter doing this.
It's a massive cash engine,
Right.
but Tennessee is pushing aggressive legislation targeting that exact model within retail pharmacies. They want to regulate the spread and force transparency into the pricing mechanics. If this legislation passes, it directly threatens the profit margins of OptumRx in that state.
And it creates a massive contagion risk. If Tennessee successfully regulates the PBM model and other states adopt that exact same legislative framework, UnitedHealth faces severe structural margin compression across a segment that generates tens of billions in revenue.
Exactly. This is why a 24.5 PE ratio leaves zero room for error. The insurance arm is regaining its footing through strict, almost ruthless margin discipline. The technology arm is building a massive efficiency engine to lower operating costs. But the pharmacy arm is currently walking through a legislative minefield. The next 4 quarters will require absolute precision.
Wow. Okay, so bringing this all together, if you're listening to this deep dive and you remember one thing, it shouldn't just be the 83.9% medical cost ratio or the 30-second AI authorizations. It should be the underlying mechanism of that shrink-to-grow strategy.
100%. The financial brilliance of deliberately shedding 2.8 million members cannot be overstated. It is the fastest, most effective way to protect a balance sheet from toxic utilization trends. But it raises a profound macroeconomic question about the structure of the broader market.
Right. The largest, most highly resourced managed care company in the world looked at the data and decided that ensuring the most vulnerable populations, high acuity Medicaid recipients, unstable ACA enrollees, and high utilization seniors, they decided it was a mathematically broken business model.
They are aggressively abandoning the highest risk pools to protect their operating margins. And from a hedge fund perspective, it's brilliant. But those 2.8 million patients do not simply disappear.
No, they don't.
They flow back into an already strained public system, or they shift to smaller, less capitalized regional insurers. If treating the sickest among us is no longer a viable, profitable enterprise for the single biggest player in the space, we really have to question the underlying financial fragility of the entire system. Because eventually, the math catches up with the market.
That is a terrifying but very real point to end on. Keep an eye on those utilization trends, watch the state-level legislation, and we'll see you next time.